Welcome to The Explainer. Today, we are diving into a really provocative new idea that's been floating around the housing market, the 50-year mortgage. Now, it's being pitched as this big solution to the affordability crisis, but is it really the answer?
The idea is already creating a major buzz. I mean, we're seeing tweets like this one from one of the largest home developers in the entire country, calling it a complete game changer. But what does the source material, and more importantly, what does the math actually tell us? All right, so here's our game plan. We're going to break down this 50-year proposal, then see how it stacks up against today's standard. After that, we'll run the numbers to see if that promise of affordability really holds up. And finally, we'll look at the system-wide risks and maybe some better solutions.
So what is this proposal that's getting everybody talking? The core idea here is, on the surface, incredibly simple. You just extend the typical home loan from the standard 30 years all the way out to 50. And the whole goal, at least the stated goal, is to shrink those monthly payments and, in theory, open the door to homeownership for more people. Okay, so to really get our heads around the impact of a 50-year loan, we first got to look at the benchmark, right? The 30-year fixed mortgage that just completely dominates the market today. The 30-year loan isn't some new invention. It was actually created way back in the 1940s to help finance all that home construction after World War II. And by the 50s, it had pretty much become the bedrock of the American housing market, a tool designed to help families build equity over the long haul. And this just shows you how dominant it really is. According to the source, over 90% of all home buyers today go with a 30-year mortgage. Its stability and accessibility have just made it the default option for generations. So why is it so incredibly popular? Well, the math is pretty compelling. Let's say you're looking at a $500,000 house. On a 15-year loan, you might be paying around $3,300 a month, but stretch that to 30 years and the payment drops to about $2,400. That makes a huge difference in the income you need to actually qualify for the loan. So, and this is the crucial point, right here, that single change, just going from 15 to 30 years, gives a buyer 34% more purchasing power. That's not a small number. That's the difference between affording a $500,000 home and maybe a $670,000 home. It is a massive, massive jump. Okay, so let's move on and see how this very same logic is being used to build the case for an even longer loan. The thinking basically goes like this. People see that huge benefit of jumping from 15 to 30 years, and they just naturally assume that, hey, extending it even further to 50 years will bring even more of the same good stuff. Lower payments, bigger houses, a stronger market for everybody. And that leads us to the central question, and really the most common assumption that's driving this whole proposal. It seems totally logical on the surface, but is it right? Now, this is where it gets really interesting, because this is what happens when you stop assuming and you actually start running the numbers from the source material. The answer to that question, according to the source's pretty detailed analysis, is a firm, unambiguous no. And here's why. Lenders see a 50-year loan as way riskier than a 30-year one, right? So they're going to demand a higher interest rate to make up for tying their money up for half a century. And when you factor in that higher rate, let's say 7% instead of 6%, the monthly payment on that same $500,000 loan could actually be higher than the 30-year option. Wild. This chart just shows the law of diminishing returns in brutal fashion. That jump from 15 to 30 years gets you a huge 34% boost in affordability. But the jump from 30 to 50 years, you get less than an 8% benefit. That is a tiny, tiny gain for taking on an extra 20 years of debt. So, okay, beyond the fact that it's a pretty minimal benefit for the borrower, the source highlights some really significant, cascading risks for the entire financial system. A major hurdle is actually a legal one. Right now, a loan is considered a qualified mortgage if it meets certain stability rules, and one of those rules is a maximum term of 30 years. A 50-year loan would be non-qualified, and that strips away legal protections for lenders and forces them to charge even higher rates to make up for that extra risk. For the borrower, the situation is incredibly dangerous. I mean, because nearly all of your early payments are just going straight to interest. The source calculates that after 12 years on a $500,000 loan, you'd have only paid off about $32,000 of the principal. Now, the standard closing cost to sell your house would be more than that.
So what's the result? After more than a decade of payments, you could literally have to write a check just to sell your house. You'd be trapped.
And the risks create this kind of double negative for the whole financial system. For banks, they could get stuck holding a low-yielding asset for half a century if interest rates go up. And for investors who buy up mortgage debt, their capital is tied up for way too long, making the whole thing unattractive and illiquid. It just doesn't really work for anyone. So if the 50-year mortgage is basically a mathematical trap, what's the real solution here? Well, the source material suggests the focus shouldn't be on loan terms at all, but on the core problem, a severe lack of housing inventory.
The analysis proposes 3 concrete steps, and they're all designed to do one thing: get more people to sell their homes. This would include increasing the tax break on profits, allowing homeowners to take their super low mortgage rates with them to a new house, and boosting tax deductions. All of these would increase supply, which would directly help with affordability.
Which leaves us with this final thought. Based on the cold, hard math presented in the source, we really have to ask ourselves, is this idea a genuine, innovative solution, or is it just a gimmick that creates a dangerous financial trap with almost no real benefit to anyone?